We think that 2016 is set to be a challenging year for the global economy. I think one of the things that makes us particularly nervous at the moment is the amount of stress that we're seeing build across global financial markets. Certainly there's a risk that this stress is telling us some really worrying things about the state of the global business cycle, but equally I think there's some degree of concern that the stress could become self-fulfilling. So greater degrees of financial market volatility could feed through into real economic activity as businesses become more cautious on investment, they become more cautious with regards to hiring decisions, and also consumers hold back from spending a little. Central banks have now had an opportunity to react to that stress, and I think in general what they've done is try to take a cautious and looser policy line to try and cushion some of the fallout effects. So last week we heard from the Federal Reserve in the United States, and I think they've become much more cautious with regards to how they will signal policy and how they will set policy this year. So I think what we found really interesting was that they're taking fairly limited signals at present from the gradual build in inflation and signs that the economy at present is remaining resilient, and taking more from the fact that this financial market stress has increased the risk to their economic outlook. So accordingly what we've seen is the Fed signal a slower pace of interest rate tightening over the course of this year. And I think that this fits with our broad house view that the Fed will hike only twice over the course of 2016. In some ways, what Yellen and co might be signaling is that they view the risks of prematurely tightening as being greater, of waiting a little bit longer and allowing inflation to build and perhaps overshoot their target a short amount in the future. The central bank which has acted most aggressively in the wake of this financial market turmoil has been the European Central Bank. Last week we saw a package of easing from the ECB encompassing both interest rate cuts, greater degrees of asset purchases under its quantitative easing package, and a targeted long-term refinancing operation for the banking sector. Within the breakdown of this, we think that the most important elements are the increase in the pace of quantitative easing. So the ECB upped its pace of asset purchases from 60 billion a month to 80 billion a month, and to help coordinate that and to improve the efficacy of that, it will start buying non-bank investment grade credit as well. So we think this is quite a powerful tool in terms of balance sheet expansion and the stimulus it provides. The second part of the package that we really liked were the TLTROs, or targeted long-term repo operations. Essentially, the ECB is offering banks liquidity, secure and stable liquidity on a 4-year horizon, at worst at a 0% interest rate. At best, if banks are able to meet certain lending targets, they will actually pay the banks by 40 basis points to carry out this operation. So we think this is supportive. We think it will help banks' financial position, their profitability, and also create strong incentives to banks to go out into the real economy and to lend. Obviously, what we need on the other side of that is businesses to want to borrow and to want to invest in the economy. But we think alongside a cyclical recovery, this is a positive step for the Eurozone financial sector. In China, where a lot of the concern in the global markets have originated, I think policymakers are adopting a dual approach. So we're seeing, again, steps towards monetary loosening, both in terms of the reserve ratio requirement loosening, steps that Chinese authority makers are trying to take, but also we're seeing a more explicit fiscal stimulus come through. So a combination in China of looser monetary backdrop and a looser fiscal backdrop, albeit a much more targeted fiscal spending plan, is something that we think will try and help to stabilize Chinese growth over the course of the next year. In the UK, the Bank of England has not taken any direct action. It's neither loosening policy nor anticipating an imminent tightening in policy. But I think what it has done is signal to markets that it's relatively content with expectations that interest rates will rise being pushed further out. So given the fact that the bank is seeing a greater degree of economic uncertainty, given the fact that we've got the uncertainty around the EU referendum coming up in the summer, I think the bank has been relaxed with markets, pushing out expectations for interest rate tightening, and hasn't looked to challenge those directly and bring market expectations back towards where it might be more consistent with the bank's current thinking.